The Shanghai Composite outperformed the S&P 500 today as rising COVID fears weighed a little bit on some of the reopening stocks. Joining us now is JP Morgan Chair of Global Research, Joyce Chang. Joyce, good to have you back on the network. When we talk about COVID fears, okay, and you can whatever insert sort of emotion you might want, China, I mean, they do it hard and they do it fast. I mean, when they lock down, they lock down. So if we're worried about COVID growth here and some slowdown, shouldn't we be more worried about China? They literally require people to have passes to leave their apartment buildings.
Well, I do think that you still have to worry about COVID in China. They're always going to have a different view, and that holds true for a lot of Asia. They treat it like, one case of COVID is a problem for everyone. But I also do think you're going to see a real rebound from the third quarter of the year. In the third quarter of the year, you had sort of at the height of the shutdowns, a 3.3% contraction on a quarterly basis in the economy. And we see that coming back to 4%. So I do see more signs of reopening. They're not going to change the hard line that they're taking on COVID right now. But we see every reason to believe that on some of the mobility indicators, it's going to be better than it was in the third quarter of the year. And very importantly, the authorities are putting in some credit easing measures right now. You had a third quarter that was very disappointing due to the property concerns, COVID, and I think you see the government now taking some action here. And we expect to see more credit easing over the next couple of months, some steps that have been announced.
It's not, Joyce, it's not just COVID. I mean, COVID, whatever it is, some people say it's going to be with us forever. We got Evergrande Group, all these property developers. Right? You've got a lot of, Alibaba's got some woes as well. I mean, what makes you more optimistic, given that it's not just the health, it's also the health of the economy from a regulatory perspective, because the government just kind of seems to do what it wants when it wants?
Well, you have to remember that in China, property, the housing market is still 60% of household wealth. So they really have to balance the financial stability concerns here. So they've come out with some measures for credit easing, for really announcing some relief that covers mortgage approvals, also M&A debt assumption, developer loans, and also the bank loan extensions, because they have to really balance maintaining the social stability in China as well. So not only do we see growth rebounding, you got to remember that a lot of this is already priced in. Now, I think there's more opportunities on the bond market. I mean, you take a look at China high yield property, you're pricing in right now a 50% default rate. Do I see the government allowing that to happen? I don't think that's going to happen. We see credit spreads that are in excess of 3,000 basis points right now. So you're going to have big defaults in China, 20% default rate. That is, that is a huge number, but it's not going to be 50%. I don't think the government's going to allow that. And we do see these easing measures that they have announced on the credit side over the past week.
Did you see Alibaba's call and report yesterday? It was a big loser, finished down more than 11%. The company talked about slowing Chinese GDP, slowing Chinese consumption. Do you not buy that?
Well, no, look, I think you've got to be selective in China right now and look at what's already priced in. I do think that on the internet side, they haven't priced in all of these regulatory tightening measures that are coming into play. So we're still underweight there. But if you look at some of the cyclicals, and if you actually look on the China property bonds for what is priced in, I do not see half of the sector defaulting. So there are opportunities there. I mean, it would not surprise us that you have returns that could be 4, even as much as 10% in China's equity market. And that on the bond side, I mean, we are seeing some bottom fishing now. We're seeing, that really on some of the higher quality names, some of the lower dollar price bonds, there are some entry opportunities that look pretty attractive here.